Good afternoon, Nick.
Hi, Ninder. It is great to be here. Thanks for having me today.
No problem. Let me tell you, for the people who are listening in and watching in, this is obviously on YouTube as well. So I was on this thing called Clubhouse, and this chap turns up, chap called Nick, who says some really good stuff, and I thought this guy is okay. He definitely knows his stuff. And anyway, so I sort of noted the name. Then I think the following day I was doing my finances, so I could listen to the thing in the background. And this Nick pops up again, and he drops a couple of more really good insights. I thought, this guy is bloody good. I'm gonna go and check him out. So then I went rummaging around, found you, and I thought, actually, this is the perfect guy to bring onto the podcast and get him writing some stuff.
There we go. So now I'm set up to disappoint, right?
No, you're not. No, you're not. No, you're not. I think Nick, it's just interesting for people to know how you meet people and how you come across their names. And then obviously I did the usual thing, went around looking. This guy I've got to find. And of course, what I also discovered was that was the first time I've used Instagram as just another channel. But it's clear through Clubhouse, it's the channel. Yeah. And so I've started to now use it to track people like you, and it's amazing.
Well, I can say the same thing back to you. I mean, your insights, we met on Clubhouse, your insights on stage, and we've shared many a stage together now over the last few weeks and months, have been exceptional. So there you go.
Thank you.
I think, when people have similar perspectives maybe on, the topics that we talk about, the business stuff and things like that, it's always good to align and share stories and collaborate like this.
So now let me tell the audience what I know about you. So Nick Bradley, for those who don't know, he's really good at how to grow your business. So he's worked with entrepreneurs, business leaders, investors. And in the last 10 years, some quite astonishing numbers. You've built, bought and sold 22 businesses. Some people can only do one in their entire life. You've done 22. A combined valuation of 5.2 billion. So over 22, there's some big ones and there's some small ones.
That's correct.
You've worked across very opaque names that people know about, things called private equity. You all have heard about private equity, but you've worked for them. Some people call them vultures, but we're talking venture capital. So you've worked with them as well.
Yep.
You've done business turnarounds, which I think will be quite interesting in the current climate. Mergers. I've been involved in one recently. 2 businesses came together with a combined total now, I think, of about 6 billion assets.
Oh, wow.
So okay. I have an understanding of what you're going to say. Obviously, acquisitions, ours is a merger, and we'll talk about acquisitions. And also you've done, and this is your topic area, specialty, scale-ups. And I'll tell you why I'm interested in that. I'm interested in how can we encourage startups who remain micro, how can we encourage them to scale? Because Nick, unless we have more scalable businesses, the economy won't flourish. We need more lifestyle businesses to scale. So I think it's fantastic.
Oh, wow, that's a great topic. I mean, we can kick that around.
Yeah. And you're the co-founder of the Fielding Group. Now, this is the bit I'm going to have to ask you this. You sold your first business at the age of 21. Is that right?
I did, yes.
Do you know what I was doing at 21? I was still in my final year of an MBA, and you sold a business. Anyway, listen.
It wasn't. Let's get into it. It wasn't the most glorious example of scale up to exit, can I say, Ninder? But you know what? At the end of the day, sometimes it's the things you go through that you learn those experiences and then apply them, right? So it's one of those ones.
Absolutely. Right. So let's kick off then. So I've already talked about startups and scale up. So perhaps you can give me, in your eyes and having worked across that many businesses, what essentially, for the person who doesn't know, is the difference between a startup and something we'll call a scale up.
Yeah, okay. So I'll give you my definition of this because there are different competing things. It's probably worth to talk about the difference between growth and scale because those words get interchanged a lot. Yeah. People don't understand the difference. But to your question, so startup is obviously the very, very first stage, the very early stage of a business formation, right? It's the birth of a business. It's quite often the creative, enjoyable, exciting part where you've got one or two or a few people just literally getting together, and they're quite externally focused at that time. So if you think of it like this, they're looking more externally at problems that exist, and they're coming up with a creative way to solve those problems in a remarkable situation. And a lot of them fail. And the statistics are pretty crazy, right? And it's still really up there, like 8 out of 10 or something like that over 3 years. I forget exactly, but you know what I mean.
Yeah.
And the reason for that is it's actually not that difficult to look out there and sort of start something based on a problem that exists, but to keep that sustainable, and therefore something that has the ability to scale, and we'll get into the definition, that takes a very, very different mindset and skill set. So what you find, and I'll give you this, when a business is going from startup to scale up, it's quite often the identity of the leader that defines, and we'll go through identity, defines the success of that transition. Because scale up is about being comfortable with complexity, more complexity, because you've got, generally speaking, more people, teams.
Yep.
It's about being comfortable with process and systems. And a lot of startup entrepreneurs are visionaries. They're creatives. The idea of process and system makes people want to kind of, jump off a building.
Yeah.
But that leadership transition is the difference, because, I'll quickly say this. You can have growth in a business at any point, right? You could be growing for a couple of weeks, couple of days, couple of months, and then it stops, right? So people who say they're growing, I go, well, that's kind of interesting, but do you know what's underpinning that growth? Scale up or scale is where that's precision and predictability. You're creating the machine that allows for the predictable growth. And so scale ups are ones that are much more valuable generally, or becoming more valuable, because a lot of the kinks are ironed out, and there's a lot more metrics, there's a lot more understanding of what the drivers of value are.
So another way of looking at it is, the business is growing, but is it growing without you? So in other words, have you got the systems and process in place that if you've disappeared for a year, it continues to operate without you because of the way it's been set up?
Absolutely.
That's a scalable business.
Yeah, it's a machine. I have 7 companies right now, and I do acquisitions quite regularly, with another 3 coming into the portfolio by the summer. And I'm not operational in any of those businesses. I go and see them once a quarter. Now, just to be super clear, I'm looking at the metrics of those businesses on a weekly basis. Yeah. KPIs, revenue, profit, whatever I'm focused on. And I run those businesses with a weekly phone call. And that's the difference between something that's built like a machine or set up in that structure versus something that the owner, the founder, has to be involved in everything for it to work.
I also say to people, it's a bit, the transition, you just spoke about the transition, and we'll come to leadership a bit later on. The transition is from being the striker to then being the manager. So the transition can be difficult. You can be a Maradona, the best footballer in the world, but can you manage and coach a team? It's a different skill set. And part of the problem is, you're Maradona, which is one of the best players in the world. He thinks everybody should be as good as him. And that's part of the problem. Is as a leader, he's going to say, well, hold on, I might have been, but anyway, we'll come to that.
No, the point you're making is an important one to underline. Ego is the enemy in this situation here. And back to your football analogy, like quite often the founder, the good founders realize that they're a striker, but most of them think they're a striker. They're somewhere in midfield. They're also a defender, and now and then they become the goalkeeper. And you can see, I can't imagine any championship team working like that. There isn't I mean, maybe in basketball.
I think that's a great example, actually, because you're right. Most startups do everything. Yeah. They stay in goal. They do the striking. They do the mid. They do everything. So, okay. So sorry. So that's that difference between a startup, a growth, and a scaling up. So why might you want to scale? What would be the motivation? Why not just enjoy the growth? What might be the motivation behind scaling? Why might you want to scale?
If you'd asked me that 18 months ago, because people come to me and they say, I want to scale, right? And so normally there's a bit of a diagnostic period where I sort of ask the question, are you sure? Because it's not what you think it's going to be. And you can still have a really good 6, maybe early 7-figure business as a lifestyle business if you want, because one of the definitions of the journey from startup to scale up is the number of staff. So if you've got, let's say, 12 to 15 people and you're prepared to stay at that sort of level, that's quite manageable by an individual. You don't have to have management layers. So in that situation, it's easy to run, and that could be a great business. But because you're asking me this now, we've just gone through, or we're going through global pandemic. My answer to that is different. My answer is that scale matters now. Timing matters because things are speeding up and there's a lot of transition and change going on right now, partly driven by digital, partly driven by what we've just gone through. But being small in a world where, more certainty and more predictability is needed, then having size is an important factor to that. I'd go as far as to say, if you're in an industry which is hugely fragmented, in other words, lots of companies trying to do the same thing after a finite number of customers, that's you're probably putting yourself into that category of one of the 8 and the 10 that aren't going to make it.
Wow, and again, you've talked about COVID now, meaning that survival is down to scale. But
One of the factors.
But also could there be? I don't want to talk about carcasses lying around. Could there be also? This is where you could vertically or horizontally take people over, because there's a lot of carcasses around who just are not going to get through it, and they're ripe for picking.
Well, the interesting thing about the word carcass is this. So there are lots of great businesses where the owner, I'm going to say is the carcass, the owner is distressed or motivated.
Yeah.
And that's what you should look for generally. So where we get into now is strategic growth. So if you've got a business that's doing pretty well, it survived COVID, it's growing, it may not be where you want it to be, but let's say it's performing okay, and you want to grow, then looking for distressed businesses that quite frankly, you can just acquire the assets. So let's say you buy your competitor down the road that's failing and you buy their customer list, you're going to double or triple your business overnight. Right. And you can probably get those deals done from very attractive ways. The second part, which I do personally, is I find very good profitable businesses where, as I said, the owner has just decided that's it. And that could be for multiple reasons. It could be age, could be they're retiring. They don't want to go through another growth phase post-COVID. They might be ill. They might have problems with their health, which is not great. But the last thing they want to do is turn up and run a business. The amount of businesses out there like that right now, Ninder, are unbelievable. Huge numbers.
How do you find them?
So there's a few different ways, but I'm a big believer in network across everything. I mean, we met, you could argue, through networking, right, on a site.
Yeah, we did. Yeah.
So if you think if you've got a business and you want to get rid of it, you're probably going to, you might not even tell your family first. You might do, but you might not. You're probably going to go to your accountant, right? Or you might go to your lawyer, or you might go to your wealth manager if you've got one. And you're going to say, listen, I'm thinking of a transition, a change, and I want to sell my business. So the first thing is build a great network with those 3 intermediaries. Okay. Then you've got brokers. There are a lot of businesses out there for sale right now, and I can talk about the ways you can acquire them. But the other thing I think is important is position yourself as someone who is looking to buy businesses just in your network. And I often say your first deal is probably on your phone already. Someone in your phone will know someone who has a business that potentially you want to acquire. So you've just got to put it out there into the world and make it known that that's what you're trying to do.
That really is an excellent point, because I try and encourage as many people as I know to network, because I said it doesn't matter how big your balance sheet is or how great your P&L account is. If people don't know you, you're not going to see those opportunities. And the more people that know you, the more opportunities will come knocking on your door. You don't have to take any of them, but they will continue to keep coming because people know who you are.
That's right.
And I found you on Clubhouse.
There you go. Well, most people, right, are afraid to ask. And I had a great guy called Steve Sims on my podcast, and he does these amazing things, like takes people down to the bottom of the ocean floor to see the Titanic, right? Crazy stuff. He works with Elon Musk at Tesla and does things there.
Oh, okay.
But he said to me, listen, the reason most people don't get what they want in life is they don't ask. And then if they ask and they get a no, they stop.
Yeah.
They don't think, well, actually, there's another way around this issue or this problem. And so when you're buying businesses or anything, actually, you've just got to be resourceful and think, okay, what are the channels that are important? So at the moment, I've got 3 businesses in quite late stage acquisition conversations. They've all come from different parts of the network. The one that I'm most interested in has come from a broker, interestingly, who just specializes in seller financing deals, which means I'm probably going to be putting a tiny amount of my own capital into the deal, which is another, bit of alchemy when it comes to this. And I didn't have to do anything. I mean, I just had to call this guy up, positioned myself in what I wanted. He went and did the work. I paid a small amount of money for the search, hardly anything, like we're talking less than thousands. And then there's a bit of a payment at the end, but it's something that people could save quite simply just by not buying Starbucks coffee every day.
Well, we'll come to funding valuations when we look at acquisition. But of course, there are lots of ways of scaling.
Yeah.
There's organic growth, just organic. What do people need to get right to grow organically, to scale up organically? Now, you talked about cash, you talked about processes, people. Anything else?
There are 6
ingredients for organic, and then we'll look at acquisition in a minute.
Yeah, so if you talk about the organic, I look at it in 6 categories, right? So, and some of them, I mean, none of them are rocket science, right? You'll know what they are. You would have heard them before. But the important thing about the categories that I look at, they come from the frame of reference of working with private equity and going into companies that are invested by private equity firms that are failing. So, and you think about what's the journey there? Well, the journey there is how can we create a valuable business, so valuable that someone else wants to buy it. That's the only thing that matters in private equity, really. Okay.
Yeah.
So the 6 areas are, first and foremost, is the purpose of the business clear? And by purpose, I mean the intent, which is a couple of different things. It's the vision. So what are we creating here? And usually that vision is towards an exit, usually in the world I'm in. Where are we today? And what are the choices, the strategy that we're going to decide on? Because you've got multiple different things you could do to get from A to B. So that's what I underpin in terms of purpose and vision. Then underneath that, you've got profit. Now, a lot of the businesses, particularly tech businesses, this, they're not profitable straight away, but they do have a pathway to profit. And the businesses I acquire tend to be profitable, but you'd be surprised how many businesses, particularly the ones that fail at startup phase, do not have a strong enough understanding of that financial management, right? So that's the second piece. Third one is the proposition, or sometimes called the value proposition. And that's like we spoke about at the beginning. Are you super clear on who you want to serve? Do you understand their problem in a very intimate way? And is your solution remarkable? And when I used to work years ago, I did some consultancy work. I worked at BCG for a while. And we used to call those 2 factors the killer equation. So understand your audience, understand their problem, and then understand how your solution is differentiated and remarkable. And quite often the secret to growth or sparking organic growth is just niching down on that target audience. It's funny because lots of people, they go, what? Go narrow? Yeah, go narrow and go deep. Because if you can do those 2 things, you'll stand out and be remarkable. You'll mean a lot to someone, not a little to everyone. Okay.
And what do you say to someone who says, I don't do anything remarkable? We do something that we just do and everybody else does it as well. So they can't see it themselves. So how do you, when you say you go deep, how do you find something that they don't even know themselves?
Well, you continually ask the question, why is one of the techniques. So why does that matter? Why does that matter? Why? And eventually you'll get down to something rich. So if I think about the clients that I work with, the ultimate goal that they want to achieve is freedom, really, and around that is wealth, and around that is impact, right? They're the 3 things that people most likely want when they come to work with me, right? So I go, okay, so that's fine. So you want to create the ability to live life on your own terms. That's the main thing. Okay, so where are you now? And what's the gap? And quite often when you get into that, you get to the pain. And the pain is often I'm overwhelmed. I've run out of ideas. I'm too in the business, even down to as far as I'm not seeing my kids grow up, right? Really deep. And because I know that about my clients, I know the target avatar that I speak to. I know what car he drives. I know his name. I know where he lives. And a lot of businesses can't do that. I don't know if you've had this experience, but you say, okay, let's go deep. Let's talk about who you really want to serve. And they'll say something like middle-aged men living in Surrey, right? Not enough, not these days. That's not going to get you to standing out and stepping up.
Yeah, I think I was fortunate with the launching of the magazine because I already had an audience through the event. So I knew what they looked like. I knew their habits. I knew where they lived.
Perfect.
Because during COVID, they gave me the home addresses. And it was a way of continuing to communicate until the events. We released the pause button. But you really do have to know, and you're absolutely right, Nick, you need to know so accurately what the customer wants on what they look, because that's your best chance. And a lot of people tend to scatter.
Clarity leads to focus. And I often say focus is a superpower, because most people, particularly entrepreneurs, they get the shiny object thing. Oh, I want to do this. I want to say yes to this. Yes, 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 yes. And then all of a sudden they wonder why they're overwhelmed. Well, you're overwhelmed because you're focusing on the stuff that's not going to get you the result. And that's why mindset, or whatever we want to call it, that identity piece, that's why it's so critical.
So why do most businesses unsuccessful in scaling up? What do they get wrong? Why is it that they do try? I mean, I loved your earlier comment about growth. They think growth is scaling. But what's the main thing that you find when people are about to sell, they just were not able to scale? What was the main
you mentioned the word. You mentioned the word leadership. And leadership, quite often people think about leadership as the ability to lead others, but it starts with the ability to lead yourself, the decisions that you make. And so just to unpack that, because I don't want it to sound too ethereal, leadership of yourself is making sure that you're doing the right things to be able to make the best decisions. It even comes down to your energy levels, how much sleep you're getting, because when you're operating in flow as a leader, right, even if you haven't got heaps of people around you, but you're leading a product, a launch, a project, whatever it is, how you then show up makes a big difference to the overall outcome. So the first part is that. So if you're overwhelmed, if you're stressed, if you're burnt out, if you're thinking that the world's going to end, all these sort of things, that's not going to get you into any state to be able to make major change. Now, this is the important piece. Culminate that same emotional state or psychology, whatever you want to call it, if you've got a team of people around you. Because everything you say, feel, and act is then transferred as almost permission to everyone else. Right? So the two most important traits of leadership in my mind are, firstly, competency. So you have to kind of know what you're doing, right? If someone's incompetent, then that's not great. But then the second one, which I think is underlined again through COVID, is empathy, right? The ability to be able to lead, other people to achieve the things you want by understanding where they're at any given time. So the businesses fail because those two dimensions don't work very well. And scale up is about the ability to build teams. So it's about leading yourself first and the ability to then lead others. And if you can't do both, guess what? You're not going to scale.
Interesting. So organic is one route. The route you've referred to and have spoken a few times already is the acquisition route. So I suppose a couple of things. Firstly, it's obviously bereft with lots and lots of problems could happen. But before we get to what you do once you've acquired someone, how do you come to a valuation before you've even started negotiating? And how would you fund, and are there sort of funding ways of acquiring the sort of business so you can scale by being with them? So I suppose the first one is, how do you put a valuation on a business?
Yeah. Okay. So I talk about what we're getting into now as strategic scale up. So you've got organic, which is the stuff you can do within the business, so fixing the marketing, all that. Strategic is the external things. There's two key parts to it. One is acquisitions, which we'll go into, and the other is partnerships, joint ventures.
Okay.
But they fall under the more strategic stuff. They're going to get you scale quicker, more exponentially, but you can only really go there once you've got your core business working, in my opinion. Right? Sometimes people try and acquire themselves out of problems. It doesn't always end very well, but that's a separate point. So to your question, so how do you value? So there's a couple of different things to look at. The businesses that I buy, I'm purely looking, because I'm buying profitable businesses. So I'm looking at the profit potential of the business that I can add to it, but I'm going to pay for what I see in black and white through the financial statements. So when I go and look at a deal, so the first thing I do, I obviously look at the deal. I build rapport with the seller. I understand what are the things that are really important in the business. How has it got to where it's got to? Then I'll do an NDA and get the financials. I look at the last 3-year financial statements. I look at P&L. I look at balance sheet, cash flow, and then I look at the forecast for the coming year. And I usually negotiate the price of a business based on the average net profit of the preceding 3 years, even though normally the negotiation starts to bring in the current year, which is the run rate. And somewhere between those two figures, you will get to a multiple which is often referred to, which is a multiple, in the case I'm talking about now, of the profit, the net profit of the business. You can have multiples based on revenue for technology businesses, and there's a whole heap of other things, but just to focus on the ones I'm talking about. And I tend to buy businesses between $1 and $10 million or pounds, that sort of range. And I like to pay no more than 4 times profit, usually around 3 or a little bit under, sort of between 2.7 to 3.2 times the profit of the average of the last 3 years trading.
Interesting.
That's how I do it. It's a very big question because you can value businesses based on brand, but let me explain why this is important for people. The strategy I have and the strategy that I advise on is buy a good business at the lowest possible price. Makes a lot of sense. It's like buying a house that just needs a little bit of work, right? It's a great house, best house on the, worst house, best street, that sort of thing. But work out how you're going to add value. Now, if you can come into that business, let's say it's a traditional engineering business up north here in the UK, profitable, 35 years, consistent customer base, loyal, great brand in its niche, right? Has never done any proper marketing. You talk about a website and they go, what's a website? Right? This happens, by the way. I'm not joking.
No, it does happen. It does happen.
Yeah, and you sit there and go, well, okay, well, have you ever heard of digital marketing? Have you ever heard of direct response and building a list? Anything, right? Have you ever heard of partnerships to kind of combine resources? So if I buy that business for 3 times EBITDA, net profit, and then I improve the marketing and I can scale it organically to your initial point, that multiple is going to increase. So if I sell the business and I've grown it, let's say I've doubled the business, that multiple is not going to be 3 times when I sell it. It might be 5, it might be 6. If I buy other businesses and bolt them all together and form a group, it's called a roll up, and I increase that EBITDA, that net profit, the more profits, the more scale that comes in, the more it opens up the buyer network. It opens up private equity specifically because there's thresholds. But here's the clever bit. It's called multiple arbitrage. I buy at 3, buy all these businesses at less than 3, and then I sell them at 6, 8, 10 times what I paid. Okay, and that's the difference. Lots of people become billionaires through private equity because of that arbitrage. And it's one of the things that most people don't talk about, but it's a very clever way of looking at it.
So let's just pick up the first principles. You look at the P&L account, you look at the cash flow, you look at the projections, you look at the balance sheet, you look at the earnings before interest and tax, the EBITDA, you look at all of that, you buy it. What about when you open the bonnet and then you start to look at the people in the place, the culture in the place? I don't know how you would value its reputation and brand. How often have you seen something that looks different from the numbers to when you open the bonnet?
I mean, every deal is. So, but you de-risk it. So one of the things that's probably worth again underlining here is I'm not deploying much of my own capital.
Yeah.
I'm buying these businesses through a couple of different mechanisms. It's called a leverage buyout is what it's called, an LBO. Most people think when they sell a business, and this is probably worthwhile people listening to learn this, if you sell your business, you're not going to get all the cash on day one.
Yeah.
Right? You're going to get it over time. And usually it's called it's called vendor financing or seller financing. So let's say I buy a business and it's the owner is distressed. So they want the business gone. If I don't buy it, they haven't got that many other options. 1 in 12 businesses for sale that's in that sort of lower level is going to sell. The rest will close.
Wow. I didn't know that. Is that right?
2 things are happening. And I probably should say this. In the US alone, every day, there's 10,000 baby boomers retiring. By the end of 2030, every single baby boomer, if you like, that when they were born in sort of post-war time, post-Second World War, will be over the age of 65. Now, a lot of them are business owners, and a lot of them haven't got strong succession plans. And so the reason they close the businesses down is there is no buyer. So if I turn up and say, and this is the bit, I turn up and say, okay, listen, I'm going to pay you 3 times profit. They go, oh, I want 5 times. Okay, well, that's not going to work for me. Thanks very much. Then they go away for a bit and they come back and say, oh, you know how you offered 3? That sounds really interesting. Can we talk again? And what's happened in that, few weeks or months in between that conversation is that they've realized that the only other option they have is either stay in the business and try and make it work. And they're sometimes in their 60s and 70s, or close it down because they haven't got any other option. So in a situation like that, I'll turn up and say, okay, here's the deal. I'm going to raise some finance against the assets if there are assets in the business, and there are, you can raise it against receivables and all sorts of things, as well as plant and machinery, depending on the industry. And I'm going to raise, let's say, 30% of the asking price based on that. Then I'm going to fund the remaining 20%. It might be my own cash. It might be an investor. It's not for them to know.
No.
But I want you to hold on to 50% of the valuation, which I'm going to pay over the next 3 years in quarterly payments. Okay. And I'm paying both of those things, the asset finance and the seller finance, from the profit of the business. Now, two things I'll say just before I finish this piece. You might ask the question, why would I do that? Why, as a seller, would I accept that? Because your only other choice is closing the business. So you're better off getting some money than nothing. And the other way to think of this, to simplify it, is it's exactly the same as buying a house with a mortgage. You buy a house with a mortgage, you get to live in it, and you may not pay the thing off for 25 years, but you get the enjoyment of the house. So what we're doing here is I get the enjoyment of the company. I get the profit, in the same way you get to live in the house, and I pay the seller back over time in the same way I pay a mortgage company. It's the same type of mechanic as that.
So again, you said you would look to de-risk the people, the culture bit. I know you manage from afar. You said that, you look at the KPIs, then you pop down, you have a phone call, you pop. How do you get around the biggest businesses? Largely are driven by people, and if the culture is corrosive, and the numbers won't tell you that.
Well, I'm not losing. I suppose the point is I'm not losing any money.
Okay.
So if I get it wrong, I mean, there is a period of due diligence where you can understand it, but I'm not buying big multinationals here. I'm buying businesses around that sort of 1 to 10 million.
Yeah.
So they've probably got 30, 40, 50 people, maybe a few more in the business. So there might be some toxic cultural things, but because it's not hundreds of people, it's not like it's ingrained. So that's one thing. I can usually maybe move a few people in and out if I need to. And I've got obviously people in my world of scale up. I've got experts I can bring in to fix problems.
Yeah.
But back to my point, I've done a couple of deals where I've put none of my own cash in. I've done a few where I've put tens of thousands in. I don't want to lose tens of thousands, but I'm usually not going to lose anything. So if the business has got something like, imagine there's a legal thing that I didn't do my due diligence in, or there's it could be something, I would have known that because I would have done the work. But if something hits me blindside, I'm not investing all my money into this thing for it to be a major issue.
Interesting. And looking around, again, when you talk about scale ups, and you talked around when you work for private equity, you go in and you try and turn the ship around. And you said some of them are distressed, but the ones you go for are the profit. Now, when you go looking to scale up, do you stick around in only sectors you know well, or just do the numbers just attract you? Or is it industries where you've got real experience?
Yeah. So for me personally, I go across sector. So I go horizontal. I would call myself a specialist in business strategy, business turnaround, operations, scale up, not necessarily a sector specific person. And what's funny about that is because I've been involved in lots of different businesses over my private equity career, and I work with hundreds of different businesses now in different ways. I've worked on everything from real estate companies, online businesses, fintechs. My professional experience has been education and technology, media, you name it. There hasn't been many industries that I haven't worked in, because the principles of business, the principles of growth and scale up, work across. And the way I explain this is, it's great. You need to have an expert who understands the industry, but you also need to have someone who's an expert in business. And if you put those two things together, that's when it can be very magical. If you have someone who just knows the industry, sometimes they're not very good at business. That's not going to work, right? Yeah. So that's the way I sort of look at it. But if you're going into this world for the first time, let's say you want to become an entrepreneur through acquisitions as opposed to startup. So it's a viable route. Buy an existing profitable business and run it. And then you're an entrepreneur, or a business owner at least, right? And in that situation, I would say buy a business that you know. So if you've come from recruitment backgrounds, buy something in HR or recruitment, or in people. If you come from manufacturing or engineering, buy something in that lane, just so you know, even if just how operationally it should be run. And over time, you'll get more proficient and you can be more diverse across the various sectors.
And I think due diligence becomes easier because you know the sector well, you know people in that sector well. So, okay, so now let's look at, you just bought something, you've got your funding all sorted. Your earlier comment was, I look for things that are doing okay, they're already making profits, but they've not really hit the potential they could have. Example was your website and the marketing.
Yeah.
So when you walk in, what's the first 3 or 4 things you straight away try to sort out to get them on that road to the multiple exit? So what are the common things you go in and say, I know it needs to do A, B, C, and we're off?
Usually, one of the first questions when I meet the seller is, tell me about your marketing. So because I want to know, I want them to say something pretty average. I want them to say, oh, we don't believe in marketing. That's perfect, right? Right. Say that. And then you'd be funny. Like a lot of, it's not really an age thing, but there are a lot of people who haven't grown up with what we call digital marketing, right? And they have this mistrust. They don't understand, oh, we're a sales business. We cold call. And that's great. That's gold, right? So that's the first piece. And now, if it's profitable and that's working, then I'm not overly worried about any issues with that. I'm not going to fix it. I might try and optimize it. So that's one area. The second area I look at is cash and profitability margin. So a business might be generating lots of top line, heaps and heaps of revenue, but then it's super inefficient. A lot of the times these businesses have never thought about automation at all. A lot of them haven't got any type of CRM systems for any data. They haven't got metrics. So I tend to look at those 3 areas. I look at the marketing and the sales capability, the customer acquisition, how they do it. I look at the profitability of the machine. So the operational components, how much is it a manual process? And then I look at KPIs and metrics. In fact, I do the KPIs and metrics as best I can before I acquire the company, because I ask for customer lists and numbers and all those sort of things. But when I go in, I'm looking to optimize. And I'll give you a very quick example. A business that we didn't do the deal on because COVID kind of hit and stopped travel right in the process of it. In fact, I was in San Francisco when President Trump said, you can't fly. So I had to get back on the plane. But I was going to be, it was so funny. I literally was in the plane. I got off in San Francisco. There was 400 people on the plane, and it took 3 hours to get off because they were letting people off 10 at a time. It was painful. I ended up staying there for a couple of days and then coming back, but I was supposed to be going down to Florida to progress this transaction. And this business, it's a manufacturing business, about 10 million top line, making about 2.5 million profit, 10 years consistently, 10 and 2, 10 and 2, 10 and 2, except for 1 year, it did 20 and about 4.5. So 20 million top line, 4.5 profit, and then straight back down. And I said to the owner, I said, what happened? And he said, oh, that was the year we employed 3 salespeople. And I said, it worked, look. And he goes, yeah, but it was very stressful. And I didn't need the money, so I decided to sack them. And then I decided to cap sales every year at 10. Really? This is true, right? And then this is the funny bit. I said, okay, so at what point in the year do you stop selling, right? Or, you're full now because you're going to stop at 10 million top line. And he said, oh, we're already at 70% for this year. And this was February 2020. So he was probably going to fill up his order book by March or April and then stop or take orders for the following year.
Wow.
And that's what I mean. So you go into a business like that and you go, well, what am I going to do? Well, I'm going to employ a sales team, or at least 2 people. Just let them sell, then obviously you've got another problem, Ninder, which is now I've got to make sure the operation, the manufacturing in this place could support it. But I mean, that's an example of the sort of stuff I'm talking about. It's not overly sophisticated. It's not clever. It's just, to me, it's obvious. And I appreciate I've done this for years, but a lot of it's like common sense and logic and just understanding how business works.
Interesting. You see, you do walk in detached, and you're able to see with a different set of lens. And too often people, I think that's the reason, I sit on a couple of boards. That's the reason why businesses have boards, because people will come in and say, your question, oh, why have we just dipped 40% in sales? Oh, we got rid of our sales force. Extraordinary. Or 70% or whatever. It's extraordinary. Now, so the process of buying a company, sorting out, example, the marketing and things like that, and then turning them into a great company. So I'm in the middle of reading this,
Great book.
Mr. Jim Collins, Good to be Great.
Great book.
Yeah, I haven't finished it yet, so you're gonna have to help me here. So you're gonna have to tell me then, instead of Mr. Jim Collins, what's the difference between a good business and a great business? Because you got a fantastic experience of going in, both when you worked in corporate and for yourself. What is the distinction between the two?
Yeah, and we kind of covered it a little bit in the last narrative and story, because that manufacturing business was a good business.
Yeah,
no doubt about it, right? Predictable, profitable, not very complex, right? But it wasn't what I call optimized. It wasn't fully reaching its potential, and case in point by what we just discussed. So the thing I say good to great is better than going from really bad to good, is because if you go from really bad to good, the return of that journey for the effort put in is not very good, not very strong. You've got to put a lot of work in to go from distressed to good, right? And the value, you may think it's fine, but you're going to get more return on your investment from good to great, because you're already taking something that's got the foundations in place that are working. And it feels a little bit like tuning an engine. You're just tweaking the thing. You're bringing a few small things in that get an exponential improvement. So when I was doing transformations, which is the bad to the good, it's a painful journey. It often involves sacking lots of people, restructuring, and then you might get the business performing again. Oh, wow, we're growing again. Now we've got some profit, right? Awesome. But if I've got a business that's already making lots of profit and then I double the profit, I buy another business and I double the revenue. Can you see the value difference between those two dimensions? And the effort, let's say the effort's the same, but actually the effort to go from good to great feels easier to me because I'm not working off bare bones to start with.
You obviously worked, as you said, across many sectors, and you did say earlier on, or I recall something about mindset, the way people think. So what is important in sort of your views? Is it mindset? Is it skill set? Is it experience? How do you judge leadership? If you said I want, how do I know a good leader? How would you measure it? Is it mindset? Is it skill set? Is it experience?
I mean, obviously it's all, but if you ask me to pick one that I think makes the biggest difference, it's mindset. And just to unpack that a bit so people don't think it's like an ethereal term, a lot of it is back to what I said about personal leadership. It's about resilience. It's about grit. It's about being objective. It's about managing your emotional state. The way to best understand this, I think, if you're in an emotional state, quite often a lot of irrational thinking comes from that. And if you think of business success as the ability to make quality decisions, right? And one decision either way could make a fundamental difference, particularly as a leader, because that's really what you're doing. You're not in the detail, you're making decisions. Someone who has a strong mindset, a growth mindset versus a fixed mindset, there's quite an interesting definition between the two, is going to be more objective, more present, more in flow. And the decisions, therefore, that they make in that state have a greater chance of being successful in terms of what the business is trying to achieve. So to bring that back a step, let's say I said skill set and not mindset. Let's say someone's the best marketeer in the world. Okay, they're a CEO, but they came from a marketing background, but their belief system's all over the place. They don't believe that they can win. They think the competitor down the road is going to win. They think COVID's going to shut their business down. They're worried how they're showing up at home all the time. They're worried that people think they're an idiot. It doesn't matter how good at marketing you are. You're not going to get that across well enough. Your decisions are going to be flawed because you've got all this cloudness coming across. That's why it's such a critical part in business success, in my opinion.
And how can you spot or measure the mindset? How can you tell someone's got the right mindset?
Quite often, if I'm working with someone, it's the it's understanding a little bit more about their broader world, Ninder. It's understanding about not just what they do in a work context. It's understanding what they do in terms of their interests and understanding more the whole person. A lot of the most successful leaders that I have worked with or had the privilege to mentor me and things like that, they have habits, they have routines, they're working on themselves, they're constantly learning. They have, a bias for action. There are certain traits and attributes. It kind of comes under the sort of terminology of attitude and character. And those things show up as much as they do outside of work, certainly in the business. So if someone, I'll give you a classic example, and it's funny, I run these crazy things called ultra marathons. And,
yeah, you do it. I was going to come to that.
I'll tell you, funny. There was a study done. I'm not sure if it was by Harvard or someone, but it was a big study done about how many CEOs of Fortune 500 companies run marathons. And there's like a crazy number, or certainly do endurance. And the way I think about that is, what does that say? Well, that says that you're working on your mind. You're working on something tough that's going to, build the muscle for other challenges. And I've gone into companies that are quite successful, but the CEO is all over the place. And I've seen this in private equity too. For a short period of time, that can work, but over time, it doesn't work because the CEO either burns out or they don't show up as the best leader. And sometimes those small decisions that don't seem innocuous at the time, they become like a cancer in an organization, to your point around culture. So all of it permutates over time.
Now but we've got a roadmap now on the way out of lockdown. A lot of people were fearful. A lot of people are still fearful. There's a lot of talk around mental well-being. But how do you turn, because I'm just picking up everything you've just said about abundance mindset and habits, and how do you turn those challenges, and that's what people see them as, real challenges, into opportunities? And I'm talking as somebody who believes passionate in scaling up.
Are you talking about someone who, but back to mindset, are they fixed in their way of thinking, or are they open?
Yeah, just generally now, if you're emerging out of COVID now, everything was a challenge, but now suddenly, and I think it was Winston Churchill said, don't waste a crisis. Isn't that right?
Yeah.
Don't waste a crisis.
I tell you what to do. Go and Google all the companies that were formed in crisis, right? Disney back in the Great Depression, I think it was 1929. You've got the Hyatt group of hotels was in the 50s after, again, another major thing. You've got some pretty big examples. I think Apple was another one. And it comes back to what I said beforehand. When there is a systemic change in society, new things are formed. It's exactly the same as, like, back to my analogy of building a muscle. You've got to break the muscle first before it grows. So if you look out there now into the world, so this is my prediction, by the way, so no data behind this. I haven't read an article. This is just what I'm seeing, being kind of externally focused. I don't think people are going to go back to the way they used to work. I wouldn't be investing right now in commercial real estate. I would be buying houses like I am, living out here 2 hours from London, because I can see the prices going up. The idea that local communities will matter in a different way, right? And there's things like that. I mean, online retail, all that sort of stuff is obvious. Yeah, of course, that's not going to, people are going to be different about that. Do you need a bank anymore? Right? You're starting to see the deregulation and the decentralization of financial institutions. So the reason I'm saying these things is, if you get a little bit more macro, the 50,000-foot view, and start to look at change that's happened since the pandemic, I hate the word pivot, but you have opportunities to change your business model. You have opportunities to start new businesses. You might have to have the painful conversation with yourself, like, well, perhaps I need to not do what I was doing. That's painful, but I know. But there are more opportunities around now, I think, than there are constraints or limitations. But I'm not saying it's easy necessarily to get to those things. You've got to maybe go on a journey, but they exist if you start looking around for them.
Nick, this has been fascinating. I did not think when I started that we'd be talking about the mind, about leadership, about habits, about muscles, marathons. I just thought, there's a company, let's just go and buy it.
Well, we did talk about that for a lot. So, you know,
Yeah.
I don't want to disappoint you. I told you you'd be disappointed.
No. But you know, it's a lot more complex. I love the idea where, you know, sometimes you can buy a company without actually using your own money, which I thought was quite a revelation.
It's alchemy.
I thought your emphasis on KPIs, on data, understanding the psychology of the person who runs the business you're about to buy, because you'll then work out how culture's mapped out. And in fact, that then helps you when you do the under the bonnet, because actually you've worked it out already with some great questions when you first meet. And of course, I suppose I'm not surprised. Australia is known for kangaroos and brilliant cricket and resilience.
Convicts as well. You know, there's a lot of, well, you know, we were originally convicts. We were pretty resourceful because we had to be.
but they're a resilient bunch, the Australians, and they're hard at what they do, and they're going hard. But at the same time, what you've introduced today is not just all those business disciplines, but actually the empathetic side, understanding and drilling down to your consumer avatar. An all-rounded discussion, to be honest with you, not just about scaling up, but all the processes and motivations. So I was right when I heard you on Clubhouse. I knew you were good, and you proved.
I've got some dimensionality to me. How's that sound? Whatever that means. That's a big word.
Well, whatever that means, and whatever it means, I'm going to write it down. And next time I'm on Clubhouse, I'm going to make that quote.
There you go. There you go.
Well, listen, thank you very much, Nick. This has been fascinating, and really the way you've drilled into some of the comments. So, look, I'm looking forward to your article for the next issue as well. I
can't wait. Well, the magazine's arrived. I've got it here, so I've had a good look. I thought the production quality, I'm holding it up for everyone who's listening. Fantastic production quality. My background was magazines years ago too, so I still have an affinity for this kind of thing. I spent 15 years in magazines, man. So there you go.
Oh, well, I shall have to have a separate call with you just to get your insights into that. But look, thank you very much, Nick. And I'm sure at some point, I'm going to hear your tone somewhere, your voice somewhere in some room on Clubhouse.
Yeah, well, listen, it's been an absolute pleasure, Ninder. Thank you very much for having me here today.
Thank you very much. And listen, have a great day. And thank you once again for giving us your real valuable time. Cheers.